the tax universe in general. A loss is a loss, whether you categorize it as a passive universe loss or an active universe loss. If you're a novice looking at a TikTok video, I did this Airbnb and it saved me hundreds of thousands off my taxes. Unfortunately, like there's these awesome strategies, but there's so much context behind who's actually eligible to do them. There's a lot of details, and your eligibility for how much it makes sense depends on your situation, active versus passive, real estate professional or not.
Seen it messed up dozens of times. Talk to your CPA, we'll get you in the right direction.
I believe this is one of the biggest superpowers on the tax code. If you have a married couple, one's the other one's a second superpower is that's where all the magic happens. There's a lot of strategies that are advertised on TikTok and other social media channels, how real estate can save you millions of dollars. However, there's lots of rules and lots of audit risks. So today we're going to cut through the noise and show you how to do this legitimately and how to maximize your tax savings. Well, Nick, tell us what exactly, when I view real estate and the tax universe in general, I generally think of like two universes. So there's the active universe where you have a high income W-2 physician or executive, and then there's this passive universe. So can you just give us a quick breakdown of the difference between the two? Because I think this is, if you're a novice looking at a TikTok video of, I did this Airbnb and it saved me hundreds of thousands off my taxes. I think we need to preface this, the baseline of those two universes and how they can intersect based upon the elections that we're going to talk about today are crucial.
Yeah, absolutely. So really, I mean, passive losses aren't going to do too much for you. If you are recognizing a passive loss, which means you're not really, that's all real estate, unless we get into this real estate professional election that we talk about today. A passive loss you're not going to be able to use to offset your wages. You know, if you're a business owner, if you're a shareholder of a S corp or a partner in a partnership, you're not going to be able to use those losses to offset that type of income. It's not allowed unless your income is below $150,000. Okay, then you're allowed to use some of that passive loss to offset that income. All right, but when we're talking $1 million, $2 million of wages, you cannot use those real estate losses unless you are a real estate pro. That's the passive trap. Those losses aren't wasted; they're carried forward indefinitely until you sell the property, until you recognize passive income. But in that year, you recognize it, you're not going to get much benefit out of it.
Yeah, so let's go through a couple examples. I think there's real estate can be the most beneficial if you have other real estate, right? So like, let's say you have a property that's paid off and it's a commercial real estate building and it's producing like $1 million a year of net profit, right? And then let's say that's like your side hustle. So you've got like your $1 million W-2 on the side. Then let's say you buy another brand new building. It needs a lot of work. That new building you can depreciate. I wanted you to tell me like what are all the deductions you can take. But the reality is that new building is immediately beneficial because in that example, that $1 million profit, that first building, that's in that passive universe, that passive income. Yeah. And so any kind of losses on the new building, the improvements, the depreciation, all this stuff, that's also in that passive universe. So that can offset, passive losses can offset the passive income, right? Correct. Yes. So what all, if in that example, and I have 4 examples in mind. So in that first example, what are all the ways with the new building? I know depreciation, I know improvements. What are all the ways that we can generate passive losses for that person to offset that $1 million of passive income?
Probably the number one, the biggest thing is doing a cost segregation study, which I think we'll talk about a little bit later on in the video. That will take the property from being, strictly 27.5 or 39-year property to being 5-year, 7-year, 15-year, and 27.5 or 39-year property. You might ask what the benefit of that is. You can take some bonus depreciation on that 5, 7, and 15-year property. That would allow you to write off a significant portion of a new building purchase. Okay. And again, we'll talk about that more a little bit later.
All instead of that, what is it, 30?
So commercial's 39.
39.
And residential's 27.5.
Okay.
So let's say you buy a building for $500,000, okay, a house or something that you want to rent. We'll say the building value of it's 80%, the land value is 20%, right? So your building is depreciated $400,000 over 27.5 years. The mental math, I'm not going to do that. That's not very much per year,
Let's do that real quick. 14,545. So yeah, 14,000 per year.
Per year.
That's not really going to do much against that $1 million of your profit from the.
Correct.
Gotcha.
Exactly. Versus if you do this cost seg, which is really more for commercial, non-residential, you might get a couple $100,000 of write-off in that first year.
Let's talk on a percentage basis. So let's say that first building, someone has purchased the $5 million building. It's paid off. Now it's netting $1 million of profit. So let's say they purchase another $5 million building. What's reasonable? I've heard like even sometimes 40 to 50%. So they can get like a $2 or $2.5 million deduction.
Yeah, I've seen up to like $2.5 million in that scenario. So 50%. Okay. You might be able to more reasonably expect 25, just to not, get your expectations too high.
So in that example, though, if they're able to, let's say the cost segregation was able to 40% of the 5 is $2 million, and that person's not a real estate professional, that $2 million they're not going to want to take in year one because they only have $1 million of passive income to offset. So they would actually want to take out of that $1 million of that, carry forward it again to the next year, the next $1 million, the next year, right? Because you could carry forward, I guess.
Really, probably the most beneficial thing to do would be to take that $2 million in the first year still, because what that would do then is it would create that $1 million passive loss carry forward. The other option would be, and I don't usually recommend this, is you can elect out of bonus depreciation at that point.
Okay.
But now you're taking that loss over 5 years, 7 years, instead of having it all up front to carry forward the next year.
Okay.
So that's kind of the difference. So you can do either or, depending on how your situation, one might be better. Typically, in my experience, the taking the full 100% depreciation, bonus depreciation, and carrying forward the loss has been the best.
Absolutely. Okay. So let's talk. Second example I want to talk about is, instead of approaching this like every rule, I think we have real life stories we can go through, right? So here's a client, adjusted gross income about 2.9, married filing jointly. So federal taxes after, and this is made up of like mostly W-2, some 1099 incomes, federal taxes of like 950 grand basically. State taxes of 90 grand. It's a lot of tax. I mean, it's over $1 million of tax, right? So then you have Social Security, you have Medicare, et cetera. So these two physicians in this example, one physician, one's a business owner, both have full-time jobs.
Yeah.
So they recently approached me about like, hey, we have a friend, and we're going to go to scenario 3. The friend is a physician. The spouse was a stay-at-home mom. The kids are just out of the house now. Okay. So now the spouse is getting into real estate. So in scenario 1, we talked about the passive income versus passive loss. Scenario 2, we're going to talk about 2 W-2 active professionals. So if they go purchase a building and they're making this $2.9 million of adjusted gross income, they purchase this $5 million building, hypothetically. They do a cost seg. They have $2 million loss. That $2 million loss isn't going to help their $2.9 million of active income because neither of them can take. First of all, they have no other passive income. Like all their wealth is like, well, technically, I mean, they have a non-qualified account, which could help, but they've got lots of 401ks, private investments, back to a Roth IRAs, a healthy brokerage account. But in general, that $2 million deduction is going to stay in this passive universe. It's not going to transfer over to the active universe.
Correct.
So they're still going to pay the same amount of taxes forward. So
exactly.
My understanding, this $2 million loss would go on their tax return as a carry forward, but it wouldn't save them at their top 37% federal bracket. Yeah. It would start chipping away if they had capital gains in their stocks. They could get the next $2 million of that out tax-free, right? Because those offset dollar for dollar.
No. Capital gains can't be offset with the passive. Because even though it is passive in nature, it's a different type of passive.
So if they sold the building for a loss,
yes,
then it would. Okay,
correct.
Gotcha.
Yeah.
The $2 million of the passive loss is not going to help this active $2.9 million income at all. It's not going to save them at all. They're still going to be on track to pay $1 million in taxes.
Exactly.
So the $2 million loss they carry forward in the tax return, what happens to that, or can they ever benefit from that?
Yeah, so it carries forward indefinitely, okay? There's no time, there's no 20-year limit, 10-year limit, 5-year limit. So you can carry forward for however long until you use it up. How do you use it up? Well, you start to get passive income. So maybe that property starts to turn a profit the next year, right? Maybe it shows 200 grand of net income of taxable income. You can use up 10% of that $2 million carry forward to get that down to net zero. The other way would be, say in 5 years, you're like, screw it, I want to get out of the real estate game. I don't want to be in it. It's a headache. I don't feel like dealing with the tenants, whatever. If they sell the property, that opens up that $2 million loss to be taken.
They sell it for 5. They're basically selling it for 3 at that point.
Correct.
So now we have a capital loss that could offset a capital gain in their stock account.
It will actually be an ordinary loss.
An ordinary loss.
Yeah.
Okay.
Correct.
A short-term or long-term loss, those can all offset stocks if they're long-term, short-term, right? That universe, a loss is a loss. A loss can offset a gain from an investment perspective.
Yeah.
Do I understand that correctly?
Yeah.
Okay.
For sure. But from a real estate perspective, so say, you bought it for $5 million, you sold it for $5 million, maybe you took 50 grand of depreciation. You have a little bit of recapture there. So you had a little bit of a gain there. That $2 million loss that we're talking about now, that can be used to offset that $2.9 million in wages. So that is allowed in the year of disposition.
That's a strategy for number 2. They could buy it, hold it for 13 months, take that big cost seg.
Yeah.
Then 13 months later, then take it.
Correct.
Does it have to be 13 months or does it have to over a year?
Be held?
Yeah. For the ordinary loss for that strategy you just talked about.
It's the year of disposition. So if you buy, obviously it has to be reasonable.
Can you buy and sell in like a month later?
You could, but what are the odds you're going to recognize a huge loss?
Well, if you did the cost segregation, wouldn't there be
if you did the
loss?
Well, so let me back step here. So
you need that to go on your tax return first.
Correct.
And then you do have to wait a tax.
Depreciation, the asset has to be in service for a year.
Got it.
If you sell it within a calendar year, you're not allowed to take depreciation on that asset.
Okay.
So because of that, you'd have to hold it for at least a year, get that loss on the return. Then you can turn around and sell it.
Got it. Okay.
So
that's good to know. That's a little loophole for the high income.
Yeah.
Okay, so let's go to scenario 3. So scenario 3 is let's just use a business owner's making $1 million. The spouse was a stay-at-home spouse, take care of kids. The kids are now off in college. The business owner has, let's say, a manufacturing business or something with inventory. So they have a lot of commercial real estate. They have office space, they have commercial real estate. And let's say they're in the middle of purchasing another building because the business expanded. So this spouse has, let's just say hypothetically, was a school teacher.
Yeah.
And they could go back to work making 90 grand a year. Or they could become the manager of the real estate. And I believe the rules, correct me if I'm wrong, is this has to be, to claim this real estate professional, you have to spend at least 750 hours or more per year. You have to have that documented. Plus, you have to have spent more time on than anyone else involved with the real estate, right? So if you have a property manager that's spending 751 hours and you're 750, it's not allowed. So you have to be, that person would have to be 700. You have to be the primary. And then does it have to be the main thing what you do? So like if you have another job, like that can't be more time than the real estate, right?
Yeah. Let me real quick, 1 second. Let me back up to our prior example.
Okay.
So the reason that might not actually be a good tax strategy is because your basis in that property at the cost seg point would be $2 million less. So you might be able to take that $2 million loss, but your gain's going to be $2 million, if that makes sense. I just wanted to backtrack.
You could pay a gain of $2 million at capital gain rates and then take the $2 million loss of the 37%
No,
rates?
because the depreciation will be subject to recapture at ordinary tax rates.
Gotcha.
At that point, I believe.
So that's almost a wash.
Yeah, it would almost be a wash at that point.
Gotcha. Okay.
In this example, it has to be more than 50% of your time. So It doesn't have to be the only thing you're doing, but it is pretty hard to get to that point if you're a W-2, if you're a doctor, if you're an attorney or something along those lines where you're working 2,000 hours a year. Because you yourself then would need to work in real estate
2,001 hours. So now you're working 81 hours a week.
Correct.
40 hours at your day job, 41 hours.
Yeah.
Okay.
Exactly.
So where this doesn't work if you're like a super high income business owner, physician, executive, hypothetically, and you're buying commercial real estate. Most likely you would have to, by yourself, categorize that as a passive world, which would have very minimal, big tax benefits, but very minimal like that year or even ongoing.
Long term.
Not going to help your huge active income empire that you build. Yep. Now, if you have a spouse who can dedicate their working career at least 750 hours or more, the rules we talked about.
Yep.
If you're married filing jointly, 6,500 one the other, it all comes together, right?
Sure. Yep.
So now this spouse can come in your real estate empire and the cost seg, the depreciation. So let's just say this person's making $1 million, spouse 1, spouse 2 is now the real estate professional, the cost seg that we get $2 million year 1, that can offset that $1 million.
Correct.
So now their income zero and they have a growing real estate empire.
Correct. 100%
as well. This is like a I believe this is one of the biggest superpowers in the tax code. If you have a married couple,
Yep.
one's high incoming, the other one's a real estate professional, and you're interested in doing commercial real estate.
Right.
There's really nothing better.
Couldn't agree more. The one thing just to mention is that even if your spouse is the one that qualifies for Real Estate Pro, that since it's a joint return, that allows all the losses. So even if you own that commercial property jointly, it allows that taxpayer, the primary taxpayer.
So it doesn't matter if the spouse doesn't have to own it. Could you own it?
Yeah, correct.
So you could own it 100%, have a prenup agreement.
Yep.
You get married, your spouse suddenly comes in, that's their full-time job.
Yep. It's a joint return. It's a joint, basically, election at that point to a degree, even though it's her election. It'll allow all the losses to be taken.
Gotcha.
Yes, sir.
That's huge.
Yeah.
Have you ever had a client put on their dating profile looking for a spouse that can do
looking
my
for
real estate?
Yeah, right. I have not seen that,
No.
but who knows? Maybe one day. One thing I do want to mention, just because it is super important. So if you're going to obviously talk to a CPA, if you want to make this Real Estate Pro election, the biggest election that you need to make outside of the Real Estate Pro election is regulation 1.469-9G. Okay. What that does is
This sounds really nerdy.
yeah, it is. What that does is it groups all your real estate together. Okay. So you only have to meet that 750 and greater than 50% test for all your properties. If you
Gotcha.
don't make that election, you have to pass a test for every property. So if you own 5, 6 commercial real estate properties, you would have to pass that test for every single property.
Gotcha.
If you make that election, it lumps it all together. You only got to pass it once.
Can you give us an example of that?
Let's say, you have 4 real estate properties. Okay.
Okay.
Your spouse, like we were talking about, is the main one kind of running the show. She's the one doing the 750 to 1,000 hours a year doing it. If you do not make this election, she has to be 750 hours at each property. If you make that election, it's just 750 and it's all encompassing your real estate portfolio.
Okay. That's
it's actually a very huge issue with IRS.
Do you see mistakes?
I personally have not seen that made, but it is cause for audits. I've seen that, not me personally, but I've seen that is a big red flag to the IRS. Obviously, if you don't make that election, no one's going to qualify for that if they own 4, 5, 6, 7, if not more real estate properties.
Makes sense. Makes sense. Yep.
So it is a huge red flag. So make sure your CPA is making that election for you.
No question. So we talked about the passive versus passive. We talked about the two spouses. Neither of them could qualify the real estate professional. We talked about the third example was one high income spouse, one real estate professional. That's where all the magic happens. You have the high active, and you can take this passive universe and turn it into active losses, and you save, literally millions of dollars in taxes per year if you keep buying real estate. I guess the fourth example, if you have a single high income earning person and they buy real estate, I mean, what's the dance? Because I do know people that make $1 million a year, and they have that pretty much on autopilot, right? So I know, he's in the corporate world, and he does tons of real estate. He claims a real estate professional, and he does have that, that pay stub that shows 40 hours a week,
right?
But he also spends, I know, he's probably working like 20 hours a week, and he probably spends like 60 hours a week on the real estate. So it's totally legit. But if he gets audited, which he has not yet, what do you think happens there?
So that's where it's really important to keep good logs, good records.
There's no law against working 81 hours a week. I think that would be his stance. Is my pay stub here shows 40 hours a week.
Yeah.
Here's my logs. I'm working 50 hours a week. And he is 100%. But I just would imagine a lot of people would try to do this and do like 40 hours a week and then spend like 1 hour a week.
Right. It all comes down to good record keeping, right? The IRS, they want their money, but they're fair for the most part. If you have good records proving that you are doing real estate that much, you're maybe not working 40 hours a week at your day-to-day job, even though the pay stub shows it. As long as you have good records, emails, keep a log of the hours you're working in real estate, things of that nature, it shouldn't be a problem. Okay. It might get questioned, right? Because if you have that $2 million W-2, but be ready to defend it. Keep the good records, and it should not be an issue.
Got it. Okay, so let's talk about just rapid fire. This would be applicable for all 4 scenarios. Just under all 4 scenarios, a loss is a loss. Whether you categorize it as a passive universe loss or an active universe loss is up to the situational awareness that we talked about. So, okay, we talked about depreciation. You can accelerate that with the cost segregation. So there's certain parts of the building. That could be a podcast episode in itself, but I would suggest, if you have questions about that, come see us. There's depreciation. What else is deductible? So if I go to improve redo the bathroom or put new flooring in or paint,
Yeah.
are all improvements deductible?
Well, yes, to a degree, but it depends. So if it's commercial real estate and you make internal improvements to the property, that is eligible for bonus depreciation.
Okay.
Okay. If you do a new roof, if you improve upon the roof, that can be qualified real property, eligible for Section 179.
So all basically in 1 year. What is it, 90% now? What's the
179, you can do a full. There's some
Okay.
rules depending on it.
I thought that went down.
So bonus was being phased down.
Okay.
Bonus depreciation was being phased down. That's coming back to 100% with the new big, beautiful bill.
Gotcha.
Those are two advantages you can look into. Now, if you add an extension onto the building, say your tenant needs more space, more warehouse space, unless you do another cost seg or, have some sort of analysis.
That'll be spread out.
That's going to be that 39-year property at that point.
Got it.
So any improvements are deductible. It's just a matter of, can we take it all year one? Can we take it over 39 years, which obviously don't want?
Or you could take it over like 5 or 7 years in some cases.
Yeah, if you do that cost seg, you might have some 5-year. You can elect out a bonus if that's more beneficial, things like that.
Got it. You can kind of bounce around with a high income year, low income year, and figure out what makes sense. Okay. Yeah, exactly. What about interest on the mortgage?
So yeah, mortgage interest is deductible.
Okay.
That is deductible. Real estate taxes, if
those are deductible.
Yep. If you're paying a property manager to kind of run it for you, if you just want to be kind of the owner and hands off to a degree, obviously that kind of discount or disallows the real estate professional side of it. But if you're paying a property manager, if you're keeping it passive, that's allowed.
What about furniture? So if I'm, let's say it's an owner occupied building. So let's say it's 5 floors.
Yeah.
We got the top floor, hypothetically.
Mm-hmm.
The real estate's owned in the separate LLC. The business is a client of that LLC, right?
Mm-hmm.
How does that work? The furniture, all that kind of stuff. Am I running that through the business? Am I running that through the LLC that owns a commercial building as the owner? Can I do either or?
You could do either or. I mean, It depends on who wants to necessarily foot the bill. As the business owner, it might make more sense to run it through the business, and basically they're more so like leasehold improvements at that point. Not necessarily
because that's basically the guaranteed active universe.
Correct.
Not that real estate profession.
Yeah. Okay. But if you want to keep it under the real estate umbrella, furniture, fixtures, really anything. So there's a number. So $2,500 is kind of the IRS like safe harbor number for fixed assets, right? Any per item. Yeah. So you buy 50 laptops, right? But each one's only $1,000. You're fine, even though the invoice shows $50,000. Write that off.
Got it.
Right now, you buy a brand new, I don't even know what I can think of, a desk or something like that cost you $10,000. So you really wanted to get bougie with it. That theoretically should be capitalized.
Okay.
Now, the nice thing is if you have to capitalize now that bonus depreciation is 100%, it's not that much difference than if you just took
Yeah.
That's kind of the nice thing about the bonus. It allows you to still get that full write-off in year one.
Okay.
Even if the asset, quote unquote, has to be capitalized.
Okay, so let's rapid fire. We have some clients that they own the business, they own the real estate. Our recommendation is they pay, so the LLC owns the real estate, and then they make themselves a client of that LLC. Their business pays rent to the LLC. My understanding is, let's say hypothetically, we have a business owner, they're paying themselves like a $250 W-2, and there's $1 million of profit. And so now they're paying a rent of $200,000 a year.
Yeah.
So basically what we've done is that $200,000, if we weren't paying rent, would fall under that profit, which would get taxed at the highest tax bracket, 37% federal. By paying it into the LLC as rent, worst case scenario, they're paying passive taxes on that, right?
Which is the same rate.
Same rate.
Yeah,
okay.
Yeah.
But best case scenario is we have depreciation, we have repairs and expenses, and the rent that goes in there is getting offset by the passive losses.
Correct.
And they're paying no taxes on that.
Yep.
So they've taken what would get clipped at 37. So what is the number there? $74,000 in tax. They've now pushed over here because of all the deductions and stuff we've talked about.
Yep.
Well, they just save $74,000 a year in tax by paying themselves rent.
Yes.
To that.
Assuming you have the deductions, the cost seg, all that stuff. Yes.
And then that 74 a year comes out tax free until those deductions run out.
Yeah.
But that's that's a really beneficial. If you're a high profit business owner, you make yourself a client of the LLC.
Right.
I mean, I would say that's a tax strategy on steroids.
Yeah. Because that works even if you are passive in real estate, if you're not claiming this real estate professional election we were talking about. Because then that $200,000 is passive income.
Yeah.
But you have that cost seg that shows that that accelerated depreciation. You can write that off, right? The 5-year, the 7-year, the 15-year property. You can get that 200,000 down to zero.
I'd say the two superpowers here would be the one high income spouse, the married filing jointly. Second spouse is the real estate professional.
Yeah.
And you just, save. That's like
Right.
number one
Save tons of
superpower.
money.
Second superpower is like an owner occupied building. You're not a real estate professional. You got lots of deductions, and then you create the income through your business that otherwise would get taxed at 37, and now it's getting taxed at 0 because you have the deductions to offset all the income.
Right.
So I would say superpower number 2 for sure.
Yeah. One thing, just because I've seen it in the past, in this scenario where you're a business owner and the real estate's owned by you, but in a separate LLC, you have to be paying rent.
Yeah.
Okay. I've never seen it necessarily questioned by the IRS, but if you're the lucky one to get audited and asked, they will be looking for that.
And you want to be paying rent for that strategy, right? Because of the...
But you do have to. I've had some clients in the past who kind of were a little, I don't want to say hesitant,
I'm trying to
but
think, the only reason you wouldn't want to pay rent if you were a real estate professional, I guess, would be one reason.
Some people just didn't feel like, I don't know, I guess maybe it's an extra hoop to jump through.
Or maybe they needed that other business to look extra profitable or something like that.
Something along those lines. But yeah, you should be paying rent to yourself.
Got it. Okay. Let's talk about a couple other strategies. So getting off the real estate well, before we stay on this, you see all these TikTok videos. Oh, I did this Airbnb and saved all these taxes.
Mm-hmm.
We've talked through the rules. I mean, you have to be the real estate professional. You have to create the hours. I know there's some different rules around short-term rentals with Airbnb. So you can get around the $750 if you're doing short-term rentals, but you still have to pass the test where you have to be the primary person. No cleaners, managers can do more work than you. And so if you're a W-2 busy position doing Airbnbs,
probably not going to happen.
And you have a property manager and a cleaner, IRS is going to be like, what are you doing here? You just purchased the thing. Like, you can't take this as an active production.
Yeah. And most short-term rentals, you throw it on Airbnb, throw it on Vrbo,
and
kind of let them deal with it,
Yeah.
And then they either have a cleaning crew or you have a cleaning crew. Either way.
Can't say how many TikTok videos I've been sent from clients. I'm like, and then I can't open the thing because I don't have a TikTok account. And so it's like, I got to send it to a friend like that's like has TikTok. And then, but it's, and unfortunately, like there's these awesome strategies, but there's so much context behind who's actually eligible to do them.
Yeah.
And so we're gonna do another podcast episode about audit and like the IRS is hiring more people to perform audits. Mm-hmm. I think this is gonna be really attacked. So we encourage you to do this if it's legit, but if you're that high income physician and just doing this like because you saw a video, I would steer clear at all costs, unless you have a spouse that can dedicate that
can be that real estate pro.
Exactly.
Yeah, and definitely, I mean, talk to your CPA, come talk to us. We'll get you in the right direction.
Absolutely. Okay, so this next one, we're going to talk about 1031s and step up. So 1031 exchange, let's say you have a property you bought for $5 million 30 years ago, and you've just banged it absolutely to the ground. So like your basis is just used up because you've deducted everything you possibly can.
Right.
So let's say your basis is like $100,000 now. So if you go to sell that thing, you have to realize this $4.9 million capital gain. Ouch. Yeah. Whereas if you just wait and die, if you have a kids, they would get a step up in basis.
Right. Yeah.
And so that's also another superpower and why you see a lot of people sitting on real estate. But let's say it's a building you really don't want anymore. You can still do the wait and see approach through what's called the 1031 exchange. So Nick, give us the rundown of how that works. And I know there's specific timeframes and rules around that as well.
If this sounds like something you want to do, talk to someone. Okay. I've seen it messed up dozens of times. Basically what happens is it has to be, say you have an investment property, like you were saying, and you find a new investment property that you really like, or you just want to be done with that initial one. Okay. You can basically transfer your basis remaining into that existing one, into the new one, not pay any tax on the gain if it's done correctly.
So a $5 million property, your base is 100, gains 4.9. You sell it and get it into the new property for $5 million. Your basis is you still have the same issue. Still the 100,000, but you didn't pay taxes when you flip building.
Right. And maybe you got a good deal in the new building. Maybe it's a more valuable, maybe long-term.
Okay.
Something along those lines.
And the reason you want to do this, if you didn't want to pay taxes that year, or if you're expecting to keep it till death.
Correct.
And assuming that step up in basis rule still exists.
Yep.
Which depending on, not to get into politics, but they affect tax opinions. And so the step up in basis, you should be aware of, it has been discussed that should be taken away. Now, it has not yet, and we don't see it happening in the next, under this new bill.
Right.
It's not there, but it could be in the next 20 or 30 years if there's legislative changes. So this strategy is not a fail-proof, but what it is fail-proof is if you don't want to pay taxes here, you want to keep your real estate thing going, you can do this 1031. So how tight of a window were we talking about?
Yeah. So let's say you sell the property. You have 45 days to find the new one and officially inform them. So let me back up for a second. So the money has to be held by an intermediary when you do sell the property. Okay. So you basically have to hire an attorney to hold the funds for you. And then you have to inform them in writing within 45 days of what your new property is going to be. You then have 180 days to close on that new property. One thing I want people to know, that 180 is not tacked on to the end of the 45. They're running concurrently. So if
that's not 7.5 months, that's 6 months total.
Correct. So if you take 44 days to find that new property, you only have, what would the math be, 130?
4.5 months.
You have 136 days then to close on it.
Gotcha.
Okay.
That's a tight window because, there's inspections, there's all kinds of stuff you have to do.
Go through.
You have the LOI, and then you have to agree on your sales agreement. And then now you're negotiating again because there's all the stuff you found wrong. Or maybe you did sign a sales agreement, you're taking it as is. But the reality is, it's a tight window. It's not stressful if you're working with a pro and you're like, okay, that's what I want. You're kind of already have a verbal agreement. But if you're have no idea what you want, it's be very hard.
Oh, for sure. It can get tight on you before you know it.
Yeah.
So you almost want to go into it knowing what your game plan is. And obviously I know things fall through, things happen, but go into it with kind of some sort of mindset. That way this 180 days isn't you're up against it. Because you don't want to be up against it.
181 days, and now you're paying $4.9 million,
$4.9 million gain,
23.8 federal, Pennsylvania 3.07% state.
Correct.
So now you're giving up what's the math?
A lot of money. 4.9
over $1 million. That's
it'd be close to $1 million. Yeah, some net investment income.
27%. Oh yeah. You're talking almost $1.5 million taxes.
Yeah,
that'd be an unfortunate surprise.
Yeah, exactly. And one thing also I've seen, to keep in the back of your guys' mind, if you have a mortgage outstanding on that property, hopefully it's paid off on the one you're selling. Paying that off counts as boot, right? That counts as basically cash you're keeping, unless the new property has a mortgage against it as well.
So it can't all carry forward.
Correct.
In that example.
Correct.
That's why you're a CPA. I'm not. Or boot and all that.
Yeah, I know.
I had a short window in public accounting.
Yeah.
I learned about all that.
Yeah, I dealt with that a couple years ago. Is that they had a mortgage outstanding on this property. They didn't really talk to us beforehand. They went through it with this 1031. Turns out it was kind of ineligible.
Got it.
Not ineligible, but they had
the meat they thought was there wasn't as big of the.
When you pay off that mortgage, you don't have a new one on the new property. That's basically cash you received, taken out of the sale.
They thought they were getting a 16-ounce fillet and got an 8-ounce.
Yeah. So
that's unfortunate, but. Okay, and just in real estate in general, I know there's a lot more details than you can go into than just on a podcast, though we wanted to talk high level because I think a lot of people think, oh, there's so much tax savings. My friend said this. There's a lot of details, and your eligibility for how much it makes sense depends on your situation, active versus passive, real estate professional or not. So we would encourage you, if you have questions or there's something you're interested or considering, come see us or go see another professional that is knowledgeable about these topics.
Yeah.
Anything else that you would add to just real estate in general, words of caution or good stories, etc.?
Really, I don't have too much in terms of good stories, unfortunately, but I can't emphasize enough record keeping, especially if you're going to do this real estate election. It is super heavily scrutinized by the IRS right now. So if you decide to do it, and again, talk to your CPA, talk to us. We'll see if it's something that you're eligible for. Make sure you have good records. There's definitely a chance it's going to get questioned, and I'm sure we'll talk about on the next video.
Thanks for joining us, everybody. Look forward to catching you next week.